Hello students, today we'll be discussing third problem on minimum alternative tax or on MAT. Now here this problem contains both provisions as per calculation of tax liability under both MAT as well as under normal provisions. I will explain you later how. Now let us only worry about MAT provisions as of now. Now they have given question as Alpha Limited earned a net profit of 15,75,000 after debiting and crediting the following items. Now again they have given net profit as 15,75,000. So this is the starting point for computation of your book profit. Then again they have given certain items which they have debited and credited. First they have given a list of items which they have debited. So we have to see among these items which they have debited, which all items should be added back to net profit and which end item should be neglected or ignored. Now provision for income tax, I told you provision anything related to income tax should be added back. So provision for income tax and interest on income tax both should be added back, and both 1,75,000 and 9,000 you should add together, and 1,84,000 should be added back to your net profit. Then again they have given dividend distribution tax and they have given proposed dividend and preference dividend. So all the items related to dividend you should add all the three amounts together and you should add it back to net profit. So dividend distribution tax, proposed dividends and preference dividend, and all these items are related to dividend, so you should be adding it back. Then again they have also given expenditure to earn dividend income, that should there's 4,500. So even this should also be added back. Then again they are given provision for deferred tax. So if you are creating, that means provision for deferred tax means this is a deferred tax which has been debited to P&L account. So there is any deferred tax which are debited to the P&L account, again it should be added back. So this 21,000 should be added back. Then again securities transaction tax, it should be ignored, so it is not a statutory addition. Then transfer to general reserve. I told you if there are any transfer to any reserve, not only general reserve, any reserve, it should be added back. So this should also be added back. Then again provision for gratuity based on actual valuation. There is no need to do anything to this. Then again provision for diminution in value of investment. So your investments are also your assets. So if there is any diminution in value of assets, then again such provision for diminution in value of assets should be added back. So this provision for diminution in value of investment 17,000 should also be added back. Then again they are given expenditure to an agricultural income. Now agricultural income and is your exempted income. So if you are incurring any expenditure to earn such exempted incomes under section 10, 11 and 12, it should be again added back. So expenditure on agricultural income and expenditure to earn dividend income, both agriculture and dividend income will come under exempted incomes. So any expenditure to earn such exempted income should also be added back to book profit. Expenditure to earn LTCG exempt under section 1030. I told you if there is any expenditure to earn long-term capital gain or anything related to long-term capital gain, it should be ignored. So there is no need to add back. Then again depreciation including depreciation of 14,000 on revaluation. So this is depreciation including depreciation on revaluation 36,000. So in depreciation including depreciation on revaluation of assets, what you have to do, you have to add. Then depreciation excluding depreciation on revaluation you should deduct. That means this 36,000 you should add, because this 36,000 includes 14,000 on revaluation, you should add. Then again for this 36,000 you have to deduct 14,000 and balance amount you should deduct from net profit as per P&L account. Then again they are given certain items which they have credited. They are given amount credited to P&L account from special reserve. So if they have any items which is withdrawn from any reserve apart from revaluation reserve, such amounts can be deducted from net profit. Now amount credited to P&L account from special reserve means amount credited to P&L account from special reserve means they are withdrawing certain amount from special reserve. So this 24,000 will be withdrawal from special reserve. So enter 24,000 you have to deduct. Then again second point, they again amount credited to P&L account from revaluation reserve. That means they are also withdrawing certain amount from revaluation reserve. So whenever there is withdrawal from revaluation reserve, that amount should be compared with depreciation amount on revaluation of assets. So this 18,000 should be compared with 14,000, whichever is less among these two, that should be deducted. So 18 and 14,000, 14,000 will be lesser and that should be deducted from net profit. Then they have given agricultural income and dividend income. It is exempted incomes. So such exempted incomes, what you have to do apart from section 1038, that is LTCG, you should deduct from net profit. So if there is any exempted incomes which is credited to P&L account under section 10, 11 or 12, that should also be deducted because it will be forming the part of your statutory deductions. So that is why I told you, please remember that format. If you don't remember that format, what items you should add, what items you should deduct, you will not be understanding. Then again they have also given some other information. Now, what information they have given? They have given here. So again, they have given some more information: bought forward business loss and unobserved depreciation. See again here they are given 3 years: 2014, 15, 15, 16, and 16, 17. So these are all previous years to previous year. Amount as per books they have given: loss 40,000, 50,000, and 30,000, and depreciation given as 70,000, 40,000, and nil. That means whatever they have given under this loss column, that is all your bought forward business loss of previous years. So whatever the amounts they have given under the depreciation column, that is all your bought forward or unobserved depreciation of previous year. So you have to add all the years amounts together. So if you add 40, 50, and 30, 1,20,000 will be your total carried forward or bought forward business loss. And depreciation, which is unobserved from all the 3 years, will be 70,000 plus 40,000. So that will be 1,10,000. So the 1,10,000 will be your unobserved depreciation. 1,20,000 will be your carried forward business loss. So when they have given the both, what you have to do, you have to compare these two. So whichever is less, again you have to deduct from net profit. So that is what you have to understand. Now again they have given you are required to examine applicability of this section and compute book profit and tax credit, if any, to be carried forward, assuming the total income computed as per provisions of income tax 1961 is 10 lakh rupees. So here in this problem again, they are given total income as per Income Tax Act of 1961 is 10 lakh. That means this is the amount of total income which is computed as per normal provisions. So if they give this amount directly, there is no need to do any adjustments. Understood? Whatever they are given in this problem, whatever they are given in this problem, that is related to only MAT, computation of MAT. So it is 10 lakh whenever they are given directly. On this again you have to calculate a tax of 25% directly, and that will be your tax liability as per normal tax provisions. LTCG ಕೊಟ್ಟಿದ್ದಾರೆ ಅಂತ ಅದನ್ನ ಡಿಡಕ್ಟ್ ಮಾಡೋದು ಅಥವಾ ಸಪರೇಟ್ ಆಗಿ ಟ್ಯಾಕ್ಸ್ ಮಾಡೋದು ಅವಶ್ಯಕತೆ ಇಲ್ಲ. So even though they have given LTCG in this problem, that is only related to making adjustment for book profits, not for this tax amount on or total income as per normal tax provisions. Understood? Then again, they have given computation of book profits. You have to start with net profit, add all the items which you have discussed above, and deduct such statutory deductions. Now I told you this you have to be very careful. Withdrawn from revaluation reserve anta kottare matra careful agiri. You have to compare it with depreciation or revaluation of asset. Whichever is less, you have to deduct. Then again, exempted income should also be deducted. Amount withdrawn from special reserves you have to deduct. But this bought forward business loss and unobserved depreciation both should be compared. Whichever is less, you have to deduct. And again, depreciation I told you 36,000 is including your depreciation on revaluation reserve. From this, you have to deduct 14,000. So this 14,000 is a depreciation on revaluation of assets. So this 14,000, if you deduct from total depreciation of 36,000, 22,000 will be depreciation excluding the depreciation on revaluation. That will give you the book profit of 17,43,500. Now again, once you get that, you have to compute both minimum alternative tax and computation of tax liability. Now we are comparing both minimum alternative tax and normal tax separately here in this problem. So for calculating minimum alternative tax, as usual, you start with book profit, then again compute 18.5%, then again you get some amount. Since the book profit is not exceeding 1 crore, there is no surcharge applicable. So on this MAT of 18.5% this tax amount, you again add health and education cess at 4%, you will get one more amount. So add both this amount, you get 3,35,450. That is your minimum alternative tax. Then total income they have only directly given 10 lakh. So on this 10 lakh directly, since it is a domestic resident company, 25% of tax is applicable, and since total income is not more than 1 crore, surcharge is not applicable. So 25% on total income you will get this tax amount of 2,50,000, and on this 2,50,000 again you have to add health and education cess at 4%, 10,000. So 2,50,000 plus this 10,000 will become 2,60,000, and that becomes your tax liability under normal provisions. Now again you have to compare both 3,35,450 and 2,60,000. Whichever is both, that will be your tax payable to the government. Anyway, since there is no space here, I could not write, but you write in your notes that among these two items, whichever is higher, that will be your tax which you have to pay to the government. So 3,35,450 is higher. So this is the amount which you pay as a tax liability to the tax authorities. Then again we will discuss another problem, fourth problem. It is simple. Now again they have given profit as per net profit as per P&L account is 17 lakhs, and again they have given certain items. Let us see. They are given depreciation of 40 lakhs was charged in P&L account. This amount included additional depreciation of 10 lakhs on revaluation of assets. So that means this 40,000 is a depreciation, including the depreciation of 10 lakhs on revaluation of assets. So this 40 lakhs you should add to net profit. Then again 40 lakhs minus 10 lakhs, 30 lakhs whatever you get, that amount will be your depreciation, excluding the depreciation on revaluation assets. So this 30 lakhs you should deduct from net profit. So this 40 lakhs you should add, and 30 lakhs will be amount of depreciation which you should deduct from net profit. Then interest of 10 lakhs due to a financial institution not paid before due date of filing return of income. So this item will neither come under statutory additions or deletions as per the format of profit. So you should ignore. Then again, provision for doubtful debts was made at 1 lakh rupees. So this provision for doubtful debts will come under provision for uncertain liabilities, right? So this again has to be added back to net profit. Then again, provision for uncertain liabilities amounted to 1 lakh. So again, this uncertain liability also is they have given us 1 lakh. So this 1 lakh and this 1 lakh both should be added together, and provision for uncertain liabilities will be 2 lakh together, and the 2 lakh should be added back to net profit. Then again 6 lakh was transferred to general reserve. So the 6 lakh, whatever you are transferring to general reserve or any other reserve, whenever you transfer amount to any reserve, that transfer of amount to reserve should be added back. Withdrawal means you should deduct. ಯಾವ್ದಾದ್ರು ರಿಸರ್ವ್ ಇಂದ ವಿಡ್ರಾ ಮಾಡಿದ್ರೆ ಅಮೌಂಟ್ ನ ಡಿಡಕ್ಟ್ ಮಾಡಬೇಕು, ಇಲ್ಲಿ ಟ್ರಾನ್ಸ್ಫರ್ ಮಾಡ್ತಿದ್ದೀರಾ. ಸೊ ವೆನ್ ಎವರ್ ಯು ಟ್ರಾನ್ಸ್ಫರ್ ಯು ಶುಡ್ ಆಡ್ ಬ್ಯಾಕ್ ಟು ನೆಟ್ ಪ್ರಾಫಿಟ್. And again they are given net agricultural income. Agricultural income is exempted income under section 10. So whenever you have exempted income, it should be deducted since it is a statutory deduction. Then again 5 lakh was withdrawn from reserve created during the financial year. That means 5 lakh rupees you are withdrawing from general reserves. So such amount of money which you are withdrawing from general reserve you should deduct from net profit. Then again below they have given bought forward business loss and unobserved depreciation as 16 lakh and 15 lakhs respectively. So whenever they give bought forward business loss and unobserved depreciation, you should compare both, and whichever is less you should deduct from net profit as per P&L account. So again this problem is quite simple. You start with net profit, whatever amount we have discussed which we have to add, like depreciation including depreciation on revaluation, provision for uncertain liabilities you should add, and transfer of general reserve you should add. Then again there are certain items like depreciation. The total depreciation is 40 lakh minus 10 lakh depreciation you remove from 40 lakhs, remaining 30 lakh will be depreciation excluding depreciation on revaluation that you have to deduct. Then again amount withdrawn from general reserve 5 lakh rupees, that also you have to deduct. Then exempted incomes, you have only agricultural income you have to deduct. Then again bought forward business loss and unobserved depreciation, if they give both you should compare both, whichever is less than the following you have to deduct. You will get a book profit of 48 lakh. Then again you know how to compute MAT. Book profit is 48 lakh. Since it is not more than 1 lakh 1 crore, there is no surcharge applicable. So find out MAT at 18.5%. So 48 into 48 lakh into 18.5% is 8 lakh 88,000. Then again on this 8 lakh 88,000 you charge health and education cess at 4%. You will get 35,520. Add both this amount together, your minimum alternative tax is 9,23,520. So this is how we have to solve this problem. Hope you have understood. In case if you do not understand problems on MAT, you please look at the format. Understand the format thoroughly, by heart the items or remember those items. Then you will have a look at these problems again. You will understand these problems for sure. Thank you.